Okay, so let's set the scene. It's February 2026. Shell has just dropped its full year results for 2025. And if you're just glancing at the terminal, well, the headlines look a little messy,
Messy is a good word for it.
right? Adjusted earnings per share, they came in at what, $1.14, against a consensus of what, $1.21. Revenue missed by over $1.7 billion. I mean, on paper, it really looks like a stumble.
It does. It definitely looks like a miss in the traditional sense.
Uh-huh.
And if you were just trading on those headlines, you would have been on the completely wrong side of this.
Because underneath all that accounting noise, the cash generation was just absolutely massive.
Exactly.
We're talking about a company that seems to have, I don't know, decoupled its ability to pump out cash from the volatility of that headline profit number.
Mm-hmm.
So the mission for this deep dive is to look past the initial stock reaction and really understand the sort of architectural shift happening inside Shell. This is a story about value over volume.
And ruthless cost cutting.
Absolutely. And a very specific and I think kind of controversial bet on the future of their entire reserve base.
It's the Weil Swan doctrine in full
Yeah.
effect. I mean, we are really seeing a shift from this integrated energy major trying to be everything to everyone to a specialized capital allocation machine.
And just for context, we're working directly from the Q4 2025 earnings call transcript, the slide deck, and all the data they released on February 5th.
Yep, all the primary sources.
So let's start with that discrepancy, the profit miss versus the cash flow. Earnings dropped to $3.3 billion in Q4, which is a big drop from Q3. So why the disconnect?
Well, the drop in earnings was largely, macro-driven. You had Brent crude down about $10 a barrel year over year.
Okay.
And in an operation the size of Shell's, that kind of sensitivity, it's just huge. Plus, the CFO, Sunit Gorman, she pointed to some significant non-cash tax impacts.
So accounting noise.
Right. And that's why the market didn't panic, because earnings includes all these non-cash adjustments. The street, the smart money, was looking at CFFO cash flow from operations.
And that number was just staggering.
It really was. Q4 CFFO was $9.4 billion. For the full year, they brought in nearly $43 billion in cash from operations.
Wow.
To put that in perspective for you, even with softer oil prices and, frankly, a disaster in the chemicals market, they are printing cash at a rate that rivals their peak years.
And they're sending that cash straight out the door to investors. I think the CFO used the word sacrosanct about the payout range.
She did. And sacrosanct is, that's heavy language for a CFO.
It implies a promise.
A moral obligation almost. They have a distribution range of 40 to 50% of CFFO. And in Q4, they hit the ceiling. They were at 52%. Raised the dividend by 4%, announced another $3.5 billion buyback.
And that's the 17th consecutive quarter of buybacks over $3 billion?
Which is the key signal here,
Yeah.
consistency. So one is basically telling the market, look, we are a bond with upside. They're engineering a yield that makes them attractive, even if you don't believe in the long-term growth of oil demand.
They're paying you to wait.
Exactly. They are paying you to wait. But to do that, you have to keep that cash engine incredibly efficient. You can't just rely on $90 oil forever.
Right. Which brings us to the cost side of all this. They hit their structural cost reduction target for 2025, correct?
They didn't just hit it, they smashed it. They achieved $5.1 billion in structural savings by the end of 2025. That is billions of dollars of overhead just permanently gone from the ledger.
And they're not stopping there.
No, now they've guided to the upper end of a $5 to $7 billion reduction by 2028.
You know, when companies talk about structural cost reduction of that magnitude, it usually implies a really fundamental change in how work gets done. It's not just, less travel and cheaper coffee.
That's right. It means headcount reduction. It means process automation, which segues perfectly into the buzzword that really dominated the call, agentic AI.
I have to admit, I'm always a bit skeptical when legacy industrial companies start throwing around AI on earnings calls. It often feels like they're just trying to juice the stock multiple. But Sawan was pretty specific here. He even called out the hype in the market, but insisted Shell is different.
And the distinction he made is really important. He's not talking about, generative AI writing emails or summarizing reports for people.
Okay.
He's talking about agentic AI in the upstream workflow. So in traditional digitization, a system gives a human some data, and then the human makes a decision. With agentic workflows, the system is given a goal like optimize the pressure in the subsurface reservoir, and the AI agents autonomously execute the technical adjustments to achieve it.
So it's the difference between a warning light coming on in your car
Right.
and the car driving itself to the mechanic and fixing the part.
That's a great analogy, yes. They're using this for subsurface interpretation, figuring out where the oil is and how to get it out efficiently. This used to take teams of geologists months.
I can imagine.
Solon claims they are condensing those timeframes drastically. And that doesn't just save money on salaries, it accelerates the time to value of a project. If you can bring a well online 6 months faster because the AI handled the modeling, that's a massive NPV gain.
And it also explains how they think they can hit that $7 billion savings target without, the wheels falling off the whole operation.
It's a high-stakes bet on implementation for sure. If the model is wrong, you just make bad drilling decisions much faster. But Sawan seems confident it's already delivering cash.
Okay, so let's look at where the cash isn't flowing. The chemicals and products division. The problem child.
Calling it a problem child is putting it very, very mildly. The division is bleeding. 2025 was just awful, thanks to global margin compression. There's a global glut of chemical capacity, mostly from China, and demand just isn't there.
And management's tone on this, it was incredibly sharp. They're talking about unit-by-unit shutdowns.
That is the capital discipline mantra again. In the past, an integrated major would cross-subsidize. They'd let the downstream business lose money because upstream was a gusher, and it all balanced out.
Someone saying no more?
Not at all. He's saying every tub sits on its own bottom. The goal now is free cash flow neutrality.
Which is corporate speak for stop losing our money.
Exactly that. They aren't expecting it to be a profit engine right now, but they are demanding it stops incinerating cash. And what's interesting is they aren't selling the assets yet.
That's the value discipline kicking in, right?
It is. You don't sell a chemical plant at the bottom of the cycle unless you're absolutely desperate. And Shell is not desperate, so they'll strip out the costs, shut down the worst performing units, and just wait for the cycle to turn before they look to sell. That's a very cold, rational calculation.
Speaking of cold, rational calculations, we have to talk about the reserves. This is the part of the report that actually got some analysts a little nervous. Shell's reserve life. It dropped to roughly 7.8 years.
Yep, down from about 9 years previously. And a 15% drop in reserve life is, for traditional oil analysts, a flashing red light.
So the immediate layman's reaction is just, Shell is running out of oil.
And that's understandable. But the nuance is in why that number dropped. It wasn't because they failed to find new oil. It's because they sold the oil that takes a long, long time to produce.
The SPDC onshore business in Nigeria, the oil sands.
Exactly. Those are your long-tail assets. An oil sands mine has a reserve life of 30, maybe 40 years. It's slow, steady, low decline, but it's also low margin and high carbon. Shell traded those for deepwater assets in the Gulf of Mexico and Brazil.
Which are the opposite.
The complete opposite. Yeah. Deepwater wells come online with massive pressure, produce a ton of oil very quickly, and then they decline fast.
So they're high-grading the portfolio. They're trading, longevity for intensity?
That is the perfect way to phrase it. They are trading volume for margin. Someone's argument is, why would I hold a barrel of oil in the ground for 20 years to make $5 on it when I can prioritize a barrel I pump today for a $20 margin? It boosts your return on capital employed immediately.
But doesn't that put them on a kind of treadmill? If your reserve life is under 8 years, you are under immense pressure to constantly keep finding new high-volume barrels. You've removed that safety net of the long-life assets.
And that is the resource gap risk. Sowan actually admitted they have a gap post-2030. They claim they can fill it with bolt-on acquisitions, but the risk is absolutely real. By shortening their reserve life, they have increased the velocity of their business. They have to run faster just to stay in the same place.
It almost feels like they're liquidating the inventory to fund the dividend.
That's a very sharp way to look at it. It creates a real tension between the current shareholder and the future of the company. If you're holding Shell for the dividend in 2026, you love this strategy. If you're wondering what Shell looks like in 2036, it's a much hazier picture.
Burning the furniture to keep the house warm.
They're burning the high-quality furniture and betting they can buy new furniture later.
And this returns first mentality, it seems to have completely reshaped their energy transition strategy as well. I mean, remember when Shell was going to be the world's biggest renewable power company?
That era is definitively over. The green pivot has, let's say it's become the green pause.
They stopped construction on the biofuels plant in Rotterdam. They sold off stakes in major offshore wind projects.
And this is a huge signal to the entire industry. Shell has looked at the math of renewable power generation and decided the returns just don't compete with oil and gas. They're not willing to accept 6 or 7% returns on a wind project just to polish their ESG credentials.
So where does that leave their transition strategy? It seems to be all in on one thing, LNG.
Liquefied natural gas is the new core. Sales grew 11% in 2025. They see LNG not as a bridge fuel but as a destination. The thesis is, as the world builds more intermittent renewables, wind and solar, the grid needs a stabilizer.
And batteries aren't there yet at scale.
Not even close. So gas becomes the essential partner to renewables. And there's a fascinating arbitrage play here in terms of who buys that gas.
The east-west spread.
Exactly. Shell noted that China and India want more gas,
Yeah.
but they're incredibly price sensitive. They want it in the $8 to $10 range.
Right.
Any higher, they switch back to coal.
Right.
Europe, on the other hand, will pay a premium for security of supply. Shell's massive trading division makes its money playing that spread routing cargoes to wherever the margin is highest.
So they're moving away from being a power generator to more of a logistics and molecule optimizer.
Precisely. They're playing to their historical strength, which is trading and complex engineering, not utility-style power generation.
I want to zoom out a bit to the macro picture Salwan painted. Despite all the talk of peak oil, he's still seeing demand grow by about 1 million barrels per day every single year.
Which is a robust rate of growth. But the really scary number he paired with that is the natural decline rate. If the industry stopped all investment today, global supply would shrink by 5% annually.
That's that Red Queen effect you mentioned earlier. You have to keep running just to stay in place.
Exactly. You have to replace 5% of global supply every single year just to keep production flat, all while demand is still growing. This creates a kind of structural floor for oil prices.
And that floor is being propped up by geopolitics. The report mentioned the Red Sea, Venezuela, Iran.
The risk premium. In a frictionless world, oil might be trading lower. But we don't live in a frictionless world. We have shipping lanes under threat, sanctions on major producers. That keeps the price floor higher, which of course benefits Shell's cash flow immensely.
There was also a specific geopolitical note on Kazakhstan.
Yeah, the Kashagan field. There are ongoing legal proceedings with the Kazakh government against the international consortium. Shell used the term disappointed and basically said they're pausing any future investment there until things are sorted out.
Which really highlights the other side of that value over volume coin, doesn't it? If you rely on these massive mega projects for your cash, you are beholden to the host governments.
It's classic sovereign risk. You can have the best AI and the best engineers, but if a government decides to change the fiscal terms, your returns just evaporate. It's probably another reason someone prefers those short-cycle deepwater assets in places like the Gulf of Mexico. The political risk is just different.
So let's try to synthesize all this for you, the listener. We have a company that is deliberately shrinking its reserve life, retreating from low-return renewables, slashing costs with AI, and then funneling every spare dollar it finds to the shareholder.
It's the ultimate exercise in capital discipline. Someone is stripping the company down to its most profitable core. He is effectively saying, I am not here to build an empire for 50 years from now. I am here to maximize the value of the barrels we have in the ground today.
It's lean and lucrative.
But the question is this a strategy for long-term survival? Or is it a strategy to, well, dress the company up?
And that's the provocative thought I want to leave you with. When you see a company this aggressively buying back its own stock, cutting R&D in new energies, and high-grading its portfolio to maximize immediate cash.
It looks a lot like a company that's preparing for a transaction. Or at the very least, a company that believes its own stock is woefully undervalued by the public markets.
Or maybe Saewon just believes that the energy transition is going to be a lot slower and rockier than people think, and the ultimate winner will be the one with the most cash, not the one with the most wind turbines.
If the 2030s are defined by scarcity and volatility, Shell is positioning itself to be the fortress. But if the transition accelerates and oil demand collapses faster than expected, they might find themselves with a very efficient engine and no road left to drive on.
A fascinating gamble. We'll be watching that reserve life number very, very closely next quarter. That wraps up this deep dive into Shell's 2025 pivot.
Thanks for listening. Catch you on this one.